We want to welcome Roger Altman. Of course, he's Evercore's founder and senior chairman. And Roger, it's good to see you this morning.
Thanks for having me, Becky.
Why don't we talk a little bit about what's happening with the economy first? Because I think markets are a little bit on edge. We know things are slowing down, but I think the question is how quickly, and is there any sort of a crash that's happening, or is this a soft landing?
I think it's a soft landing. And if I'm the Fed, I'm pleased because 142,000 new jobs, which was Friday's number, is a solid figure or decent figure, but it represents a slowing. Mm-hmm. But just in that sweet spot, it seems to me, where it's not so much slowing that it's signaling a recession. And the unemployment rate is still, or is actually 4.2%, down a bit. Hours worked rose a bit. That's a good sign. But fundamentally, I think we're seeing just the type of moderate slowing which the Fed wants in terms of its goals on inflation. And I know there's, lots of concern as to whether it will weaken further and weaken seriously. I don't see that.
I guess the question becomes what's happening under the surface, where things are headed. Why do you think that's not the case?
Because
because the market's reaction was not one that is quite as calm as yours.
I understand. Growth itself is still running, by most indications right now, at more than 2%, maybe 2 or slightly more than 2. That's remarkable 4 years into a recovery. Remember, we began to recover in the second half of 2020. And the outlook for corporate profits, as you know, remains good, 10% plus. Markets, of course, they had a bad September, but fundamentally still right around all-time highs. Open market interest rates have been falling nicely. The 10-year, 70 to 80 basis points below its peak. So
the Nasdaq's actually 10.5% below, so it's actually in correction territory.
Well, I meant the 10-year Treasury.
I'm talking the Nasdaq, though.
But anyway, I don't see a recession, and I think equity markets, would be reacting differently if they saw a recession, and they're still strong and high.
So what should we expect from the Fed? Gradual 25 basis point cuts? Most people, the markets, I think, at this point are expecting 100 basis points by the end of the year. Is that what you think, too?
I think it's a coin toss as to whether this first cut is 50 basis points or 25. Really a close call. I don't know which way that's going to come out. I agree, 75 to 100 basis points by the end of the year in terms of the cumulative cut. But I think the soft landing scenario is fully intact.
So if the Fed were to cut 50 basis points, would that signal to you that they see something else that's going on? Or why? I think there are other people who would be spooked if that happened.
Which is why you probably bet that it won't, even though I think it's a very close call. I think it's more likely to be 325s, but I think it's close.
And what would change your mind? What numbers? Because there are some people who argue the numbers we're looking at are outdated and more slowly. What are the numbers that you watch most closely to see? Well,
there's a theory that the, let's call it the underlying monthly job growth rate is weaker than it looks. And that when you add in, when you factor in these large retroactive revisions, downward revisions we've seen, that the current monthly job rate implies a higher unemployment rate. I still don't think that's a strong case for 50, but it's a case for 50. So that would probably be the mentality the Fed would bring to it if it went to 50. Now, we know from Powell's Jackson Hole speech, it was very clear that the Fed is now more focused on labor markets than on the inflation rate. PCE is at 2.5 already and probably softening further. So they're really laser focused on labor markets, and they might possibly conclude that they're weaker than they look.